tell me what 3 wins is. I know you told me before, but I can't remember.
Yeah. So when we sit down with a business owner, we talk about their financial legacy in the area of 3 wins. So the first one is why they went into business to begin with, and that's to figure out a financial legacy for them and their family, personal financial legacy. That's the shareholder win, right? What is the business doing for you and yours, the things that you care about, the people that you care about, the causes that you care about.
Yeah.
And so we walk through financial independence. We walk through, what that means, how they're going about that, their planning process, family legacy, charitable giving, all of that. And it all hinges upon the company win, right? If the shareholder win is out of balance with the company win, the company is going to suffer. They may have some great windfalls over a couple of years, but the business is going to suffer because they're not planning well. So what does it mean for the company to win? And so we talk through having a sound forecasting strategy, right? And some people are, I want to look 18 months out. Some people want to look 10, right? But how do you plan well, and what's custom for that person and their business and their industry? And who do they need to have on the team to be able to make those strategic decisions? We also look into stakeholders in general under the company win. Who are all of the people who depend on the company being successful for a long period of time? And that could be your office manager's grandson, right? You just trace that line and say, hey, my company financially and spiritually and emotionally and physically, whatever you want to look at, it blesses and benefits a large circle of stakeholders, not just the employees, but their families, your vendors, your clients, all of those different stakeholders. We want that company to win and be successful for years to come, for generations to come. And lastly is the key leader win. So if I've got people who are not owners, but act like owners, it's really a focal point in how I am distributing the financial success of the company. So if I keep all the benefit and just say, hey, I'll pay you a salary and a bonus, and you should feel lucky to work here. And, maybe in 10 years, I'll look at restructuring things, which is not uncommon in these founder-led organizations, especially with the generation of founders that's about to exit, whether they like it or not.
Right.
Then we sit down and say, hey, what's the best way to incentivize and retain and reward your key people, the people who put the extra effort in, that have the owner mindset, that go above and beyond to make whatever the benchmarks in the company win growth model that we've put together achievable. How do you let them participate in the success? And that's either through, deferred compensation, stock option, any number of opportunities for them to participate as long as they stay plugged in to that success, making that success happen.
Yeah.
And so we just model it out that way. That's the 3 wins financial model for business owners and founders that we have put together. And so that's what we named the podcast.
I like it. Yeah, there are a lot of, you guys are way beyond, a registered investment advisor, but there's a lot of RIAs in the market that try to approach helping the client in, at best, one of those legs of the stool. And so I commend you guys for taking such a comprehensive, sort of holistic approach.
Yeah, thanks. And I've not officially hit the go button on the podcast, but why don't we just include that piece too? That's good. And Brandt, we talk about it from a headwaters position, meaning the dollars that God is wanting to bring into your company. If you've got these planning steps in place, if you've got the conversation of the 3 wins mapped out, if you've got a great culture, God wants to bring business into your company. If you're treating it as if he owns it and you're acting as like the steward that he's asking you to be, he wants to bless your company. He may bless it financially sometimes. Sometimes he may bless it through other trials and tribulations that make you a better person, make your team stronger, whatever his cadence is of those blessings. we believe that God wants to do that. Otherwise, he wouldn't have given you a business, right? He wouldn't have said, hey, go and carry this forward.
Yeah.
So if the kingdom mindset is right, or you're at least pursuing that kingdom mindset, God wants to do that. So that's the headwaters before it ever comes in. And then managing it well all the way through, and then having the right distribution buckets prepared, right? Paying taxes, but strategically minimizing those, making sure that you're taking care of the company, right? Reinvestment, what does it need to do? What other investments out there that you can put money into that will continue the cause? It just happens to not be within your business directly. Personal savings and investment, what does that look like to build that so that it can continue from generation to generation? And then other strategic investments that you want to do that just happen to complement what you're already doing, whether it's a merger or just going out another direction. So making sure that those channels for the net income are correctly, it's like the delta, right? The headwaters, and then you finally get to the delta, and it's going out to these well-planned, strategically planned outlets. You're putting the dollars into those different buckets for a specific purpose. That's the full scope of the financial planning that we like to do, versus whatever ends up in the delta, that's what I'll manage, right? That's often what you hear. Whatever ends up in the delta, we start way up here. Say, hey, God's got a purpose before the dollars ever come in. How do we put that to use? And that's the part of that is the ESOP question, right? How do we bless all stakeholders? And that's the beauty of the ESOP question. ESOP's not for every company.
Yeah.
It can't be, right? It can't be. But for those that it could be, it's a really great option. But that's not all you do, right? It's not just ESOP work.
Correct.
Yeah. So Brandt Brereton, California transplant, thanks to your wife, and master of the ESOP conversation and transaction. So tell the audience a little bit about where you came from, how you got to California, and your extensive banking and M&A background before we get into the specifics on ESOP.
Yeah. So I actually grew up in San Jose, California, which is now considered the capital of Silicon Valley. When I was a little boy, it was all cherry orchards, and we used to run around and shoot BB guns, and it was an idyllic agricultural valley, really, that has just radically transformed into now, what is Silicon Valley, and very, very different landscape. Actually, my wife and I are the bags aren't packed, but close to packed to move to Reno, Nevada, to tap out of California. Can't take it anymore. But started my investment banking career literally my very first day in the business was the crash of 1987, and have lived through every down cycle that's existed since then. So, in our fourth or fifth cycle, I guess, at this point, and at age 60 next month, I think we figured out how to navigate those down cycles and position business owners for that upcycle.
It's not whether they're coming, it's managing ahead of time, managing through them, and preparing for the upswing.
Yeah, that's right.
Yeah. Somebody said the other day they were timing the U.S. one of the economic cycles. They started with the Revolutionary War, then they hit the Civil War, then they hit World War I, II, and they're just trying to map this out and say that the 2020s are going to be highly volatile. And I don't know if you could just go back and trace a map that says all of these things are linked together with the major U.S. wars. But I heard that the other day, and I didn't dig into it. You heard that every 80 years or so?
Yeah, I haven't done much work in kind of the long cycle analysis of markets, really. The thing that I've really observed, I think, over the last 10, 20 years is the Fed's response to economic crisis, even going sort of back to 08, and it was just really where it started, just an overreaction on the part of the Fed to keep interest rates, the cost of capital, artificially low, like significantly artificially low, rather than allowing it to kind of find its own natural state of being, if you will. There's a really, really good book. It's a little bit out there on the edge, but brilliant money manager and hedge fund manager, really, who called the Tao of Capital, that talks about, Austrian economics, which I really resonates with me, where if the Fed keeps interest rates really, really low for a long period of time, asset values artificially raise. And we've seen that. We've all lived through that over the last 10 15 years, and matter of time before those assets will reprice. And I think we're already seeing that, right? And so, but then the Fed doesn't do enough to we're politically driven, I think, and so there's a time of reckoning coming, I believe.
What's the name of that book you said? The Tao what?
Tao of Capital, DAO. It is very esoteric and very out there, and he draws from certainly non-Christian Eastern thought, but get past all of that, he makes really, really good points from an Austrian school of economic perspective. And not to get down into the weeds about investing, but in every downturn, this hedge fund has outperformed any other investment, because they're always dragging puts along portfolios for clients. So you may not achieve the highest investment returns in up markets, but when the inevitable happens, they crush it. And so sort of how you define success is key, and in a relationship to what the market realities really, really are, which is artificially low interest rates given where we are.
Yeah. Well, you've had much more extensive career than I have, but just in the decade that I've been in this business, there's so many different approaches, so many different theories, so many ways of looking at and saying, well, this is the best one, or they've had the most successful track record, but the qualifiers to their approach, because you can't have something that includes every approach, right? Exactly. There are mutually exclusive approaches. You can't do one and do the other at the same time. And if you're trying both, then even if you're 50-50 diversified, you're still betting one against the other, hoping that one. So that's the people who say this is the way to do it, that's their way of doing it. Yeah, you can get returns in a number of different ways. But people who say, hey, this is my approach and I'm happy to explain it to you, those are great people, because they're opening up people's minds to thought, and risk preference, personality goes into it. It's amazing how many different factors go into.
Just depends what you're trying to solve for, right?
That's it.
Not everybody's trying to solve for the same thing.
Yeah, begin with the end in mind. Well, that's a good. I'll have to check that book out. We'll put the
hard to get through, but maybe one of the best books I've ever read on economics and markets.
Yeah, I've got a few guys that they just soak that stuff up.
It's an interesting.
Yeah. All right. Well, that's good. So you mentioned not necessarily from a faith perspective. So did my screen go black for a second?
No, you're good.
Okay, good. So tell me about that. You're not just an M&A guy, right? You're not just a ESOP guy. You have a certain worldview and perspective. Tell me a little bit about your faith and how you have been able to integrate that into the marketplace a little bit.
Yeah, I'll try to be brief. Grew up in a Southern Baptist church when those existed in California. So accepted Christ at age 10, have always had that faith, and started my own investment banking business in 95. I'm truncating a long story, but started in 95, pure M&A advisory. So selling companies, private companies to public companies. But back then, back then, there were maybe a dozen private equity groups. People didn't even know what private equity groups were. So we sold private companies to public companies, and then increasingly started selling companies to private equity groups as that emerged as a large factor in the marketplace. And when Obama became president, sort of early 2000s, we had 2008, we had a compression in equity values at the same time that taxes were increasing. And so in really high tax states, that got really sideways for people. And I was thinking, gosh, people need to, how much tax they're going to pay baby boomers that have businesses to sell for liquidity and retirement is going to be really, really, really important now. It hadn't been that important before, but now that the valuations are down and taxes are up, it's getting really squeezed for wealth managers like you guys to be able to help clients achieve their long-term retirement objectives. And so I need to understand this ESOP better. So I did the deep dive on ESOP, read every book in existence, wrote my own book on it, bought into the nation's oldest ESOP third-party administration firm to kind of get under the hood, understand the plumbing of about 250 ESOP-owned companies around the country, and just became convinced that the ESOP was the future. And at the same time, the way I described it is I spent the first half of my life, and I'm embarrassed to admit, trying to get God onto my agenda for the business. And he loved me enough to turn the spigot off in 2008 when I was running my own little shop with, a dozen guys, and literally just made it really clear that I was supposed to go into ministry for an unknown period of time. And my reaction was, I'm not going to do that. I don't want to do that. And he orchestrated the situation where I had to do that. He just shut everything off. And so I got to spend 2 years inside of about a 50 million annual budget evangelical Christian ministry called City Team Ministries. Domestic and international ministry. And the way I described that is God benched me, grounded for repairs, benched me from investment banking, and got me through that 2-year period of time really, really clear. I was jacked up on money going into that experience. And God got me through that 2-year period of time, sort of a roto-rooter through my heart. I borrowed that from my partner to get really clear on money, stewardship, generosity, the things that you don't hear a lot of from the pulpit. But he benched me, did this real sort of changing of heart. And then I felt released from that back into investment banking with 100% clarity on what God's agenda for the world is, and do my little part that I get to play rather than what I was trying to do. So I'm very, very thankful for that. But total clarity on, I'm supposed to spend the second half of my life helping Christian-led business owners in the lower middle market and in the middle market, where ministry is happening in the business, unique kingdom culture businesses, and ministries happening outside of the business because of the profitability of the business, help them see that there's just a way better answer to selling that business to a secular private equity group or a strategic buyer simply for that cash liquidity event, and seeing the result of all of that kingdom impact dying. And so set me on this path to really educate as many Christian business owners as possible on what this alternative is. Not that it's the end all answer, but most business owners don't understand it at all. Most of their
Yep.
CPAs don't understand it at all because they haven't studied it yet.
Yeah.
Just the objective is how can they, with that information, then pray in a more informed way about what God wants them to do if they really are stewards, as many of them say
Yeah.
they are.
Mm-hmm. Mm-hmm. Yeah, I like that term, grounded for repairs.
Yeah, there's a half of a book written that one day I'll finish, but for sure grounded for repairs. I needed it in retrospect.
Yeah. Roto rooting your heart.
Rooting my heart.
Yeah. Yeah, those are two. That's great. Yeah, that might be the title of the podcast, Roto rooting your heart.
Yeah.
So you've made that so when did you come out of City Team Ministries, and when did you start putting an emphasis on?
I went in, so 2008 happened, and lost the business, lost virtually everything in 2008.
Okay.
Took 2 years for that to play out, and then spent from 2010 approximately to 2012 at City Team Ministries, and then felt released back into the investment banking world with almost exclusive focus on the ESOP. So today we still do, we'll still, if somebody's convinced that the ESOP isn't the right answer for them and they want to sell the business to an outside buyer, we still provide those services. But passion is helping the aforementioned type of businesses perpetuate the independence and the kingdom impact of that business that they are stewarding using the ESOP structure, and then uniquely a pocket of capital that can help lubricate, I guess might be an adjective to describe it, but historically speaking, you when you sell to the ESOP, you have not been able to get the same amount of liquidity that you would if you were selling to a private equity group, for example. And so my partners and I have formed Perpetuate Capital that structures, finances, advises, and closes these types of ESOP transactions, but also we'll write a check. So we'll co-invest, we'll lend the money to the employee trust below the bank. The objective being that the seller can achieve, by virtue of the bank and us up top, the same amount of cash at close that he would receive if he sold to the secular private equity group that's bugging him. And so if we can, normalize that liquidity slug, and they understand that they get to retain control going forward and maintain the kingdom culture and operating decisions going forward, plus that can really resonate with a lot of people and leave significant legacies through structuring help with you guys.
Yeah, and so we've come across a number of different ESOP folks, but rarely is there an understanding of how it can continue and, like you said, perpetuate. That's a great word. Perpetuate the ministry of the organization. A lot of times it's just pure transaction analysis, right? If I'm doing a waterfall and I'm looking at all these different options, and my business happens to be eligible for an ESOP, and I'm happy to stick around a little bit longer and provide leadership and transition authority, then why wouldn't I do that? But the added layer of, is this the ideal scenario for the company to continue on from a ministry perspective and be able to bless as many stakeholders as possible? Is this the ideal scenario? And that's really the key thing that I've heard out of you, which I really appreciate. So for the audience, people who are thinking about an ESOP, somebody that's saying, hey, I've heard that acronym, I'm not entirely sure what it even stands for. How does that even work? Where would I start? Kind of give an initial conversation of why would somebody consider an ESOP, and what are the key things that they need to be thinking about as they determine whether a deeper conversation would be helpful.
Yeah, so I'll start with a very quick flyover on how and why, and then I think the listener can say, does that fit me or not?
Mm-hmm.
And so, you know, most of us all have family trusts, and we put our assets in the trust, and the kids and the grandkids are beneficiaries of that trust. And the employee trust, the ESOP, I use the term employee trust, is exactly that. It is at once a retirement plan, qualified retirement plan, but it's a trust. And all of the employees are merely beneficiaries of the dollar value of the stock and the assets that are in that trust. So they never become actual owners of the stockholders. They have no rights. A lot of business owners think that why would I do an ESOP? My employees don't have any money, and I'm not going to give them control over the business. And those are the biggest misconceptions that exist.
Yeah.
They're just beneficiaries of the dollar value of the stock that you sold to the trust, and at no cost to them or anybody other than the government through tax shields.
Mm-hmm.
They're being blessed, literally given significant wealth, life-changing wealth, if they continue to work for the business for the next 10, 20 years. And so you sell the business owner sells stock to the trust at fair market value, no concession on value, same value that you would get if you sold to somebody else. They can decide whether they're going to pay capital gains tax or they're not going to pay capital gains tax legally by working with you guys on Section 1042 treatment.
Yeah.
And so economic parity and liquidity for the sellers, while at the same time being able to, up top, retain control of the board of directors of the corporation, therefore all hiring and firing decisions. So you're getting that same liquidity that you'd get in a change of control transaction by giving up control to somebody else with different agendas. Here you're keeping it, thus perpetuating the independence and the kingdom impact and the culture of the business, which can be very attractive. And you very uniquely, when you do this transaction and you sell 100% of your stock to the trust, and you get a certain amount of cash at close, and you receive cash flows, note payments out over time, there's a tax shield that the government allows in this corporate structure, where taxation on the earnings of the corporation stops. It stops entirely, and it stops permanently. So literally every dollar of profit that's generated in that enterprise going forward stays in that enterprise. So you run the business the same way that you normally would. It's just that those profits, excess profits, flow into the trust, and in the early years come right back out to you, the seller, in the form of payments.
Mm-hmm.
Those can be tax-free if they work with you guys on 1042, or they can be taxable. It totally depends. But now you have this business, this earnings engine that you are the steward of, that the government no longer is getting 30 to 50% of the profits anymore legally. And so all of the cash flow that is generated stays in the enterprise, and the board, which they control, decides where that goes. Run the business, pay back the capital that financed the transaction, build up a bunch of cash. And we structure these transactions where money out of cash flow forever pipes into donor advised funds or other charitable entities that you can help clients set up, where you can basically pipe cash flow as a legacy tithe, if you will, out of that earnings engine into the kingdom, and leave that asset that you've been the steward of, flourishing into the future, both from a cultural perspective, kingdom cultural perspective, and a conduit out of cash flow that would have been flushed down the toilets of the government had you not do this into the kingdom as a legacy that you leave forever. And that resonates a lot with people, certain people.
Certain people. Now, you would think that it would resonate with everybody to keep some cash out of the government's hands, just in general, and that, you know, you got to pay taxes to run, right? You got to there's bills to running a municipality, running a state, running a government, right? There's bills, right? You got to pay those bills, and that's not, you know, that's part of what Jesus said: pay to Caesar what is Caesar's. So I think one of you handled a lot of misconceptions. What are some of the kind of the litmus test of weeding out the folks who they want this because they think they're going to get a better deal than going to the market, and going to the market is just going to take too long, right? It's just, or it's not going to provide them as much. So what are some of the litmus test things where you say, all right, prospect A, here's what I want to know. And if I hear certain things, that's a red flag to be able to say either that person's heart's not in the right spot, or that company should not be turned into an ESOP.
Yeah. I think what I see most is business owners that have waited too long. They're burned out. You know, they've held on too long. They're at the point where they are just so fed up with the business and they're burned out, and they didn't do the work that they should have done for the year or two or three preceding that point in time, which I'm glad that firms like yours exist to help them solve. There's very few wealth managers that I see in the market that take such a holistic and comprehensive approach that you guys do. So I commend you for that.
Thank you.
They like the idea of being able to maximize the value of selling the business, which you can do in the ESOP, and you can do it on your own pace and your own control, which is, we're all control freaks, business owners. So, you know, that resonates. But they're there, and they're like, you know, everything sounds great, but I'm done. You know, I don't want to have to stay with this thing for another 3 years during the transition. So that is a major red flag. You have to plan accordingly. And what we have found ourselves doing at Perpetuate is, in response to this, taking a more active role in helping to find, outside of the business, successor CEOs, successor senior management to sort of solve for that variable, just like private equity groups do. You know, they don't expect the guy to run the business forever. For a transition period, yeah, but they've got a bench of talent that they're going to drop into the business for operational reasons. We increasingly find ourselves doing that and helping to solve for that, so that you can serve the guy who's burned himself out, because there's a lot of really, really good people that have done that with the right heart and have created wonderful kingdom businesses. And we just have to solve, if they don't get to you in time for you guys to solve that in the best way, in my opinion, then we're finding ourselves having to solve for that on the back end.
Yeah. Part of that is that key leader win, right?
Yes.
Having a team that can carry forward, you've delegated, you're out of the middle of the circle. A lot of those steps can be taken care of ahead of time. And I've got 3 or 4 examples in my mind right now. You know, the profile of the person is, I'm the most important person in my company. I'm the one that started it. Nobody knows it better than me. And if I start to delegate those things, they won't be done as well, and the company will suffer. And in the early years, yeah, probably, right? You're the wizard. You're wearing every single hat. But if your company is established and you still see yourself that way, it's only decreasing the value of your company. It's only keeping the opportunity for it to flourish beyond you, it's keeping it that hindered and really keeping it in a box.
Yeah.
And so, but that's an interesting perspective. We look at those successor CEOs, some of those, that personality, they want to be plugged in for a couple of years. They want to give it that bridge opportunity, and they're looking for something else to do anyway. And God's designed CEOs to specifically fit that bill to lead. They're almost like relief pitchers, right? Yeah. You've done all the hard work. I'm going to come in for an inning or two, and we're going to close this thing out, right?
But maybe like a 2 to 5 year gig for them, where they're receiving the succession from the seller, handling it correctly, and then as part of their role and their gig is to find somebody younger that they can bring in, mentor, exit themselves, and allow the next generation to sort of continue that.
Yeah, we've told you about the great 8, the virtues and the vices. We talked about 3 wins at the beginning of the podcast. So the great 8 is the virtues based on Matthew chapter 5 Beatitudes. And so the virtues in an organization, right? And these are not the silver bullet terms, but the purpose was to say, here are some virtues that if a company is leading both at the macro level and the micro level based on these virtues, and guarding against the vices, right? Because if you're not proactive with the virtues, the vices are going to creep in. So if you're guarding against the vices, then you have a chance at excellent, abnormal, above and beyond collaboration. If you have the 3 wins all mapped out, then you have the collaboration combined with the courage of the 3 wins, right? Because it's not easy work putting those 3 wins together. It takes a lot of thinking and planning and intentionality. We call that the collaboration effect on profit. And so we're writing a book with that title due out in a couple of months. And the subtitle of it is Overcoming the Founder's Syndrome. And that's really where that hits in, one of those examples of I can't see myself not running and owning this company. And that is a detriment to them. It's a detriment to their family. And it's a detriment to all of the stakeholders that are helping that founder and owner tell that story. And that's really that piece of, if we can help unlock that and get them over that hump and begin to solve for that fear.
Oh, it's huge.
If it's an ego thing versus fear.
Identity.
Yeah. I mean, this is who I am, but that's not, right? Our identity is in Christ, not a business that he's given us to run. Right. And that's that faith piece. It's hard to see sometimes without that faith piece, but that resonates there as far as those additional CEOs coming in. So you have a burned out person, that's a red flag, waited too long, emergency exit, just looking for a cash windfall, right, to get out of the business. They don't have any interest in staying on. Well, that particular point is sometimes a game changer if you're looking private equity too, right? They want somebody that's going to help bridge the leadership in transition gap as well. What are some other red flags that you see as far as people who think ESOP, but for sure it's not a good deal?
Yeah, you have to have, I would say, at least a couple million of EBITDA and maybe 30 employees kind of that's the edge of the strike zone. And then everything inside that strike zone is bigger than that. And so you kind of have to, for it to make sense financially, I think you kind of have to be at the edge of that strike zone or in it much bigger.
Yeah.
Then it becomes motives. Like if you are completely sold on the fact that you want to perpetuate the independence of that business, and you're willing to take as long as necessary to get liquidity for yourself, then the ESOP's going to work for you. Even if you're in a highly cyclical, crazy business where you have unpredictable cash flows that maybe be a great candidate for institutional debt that's being provided for the liquidity. If you choose to, you can still have that ESOP be your answer if it's important enough to you. because you just forbear, you wait to get paid if you get into a year or two of deep yogurt. But so that's on one end of the spectrum. To the other end of the spectrum is if you really are in need of a certain amount of cash at close within a year or two period of time from close, and a lot of people are, and that's not necessarily wrong. We had a retreat with C12 chairs last month around the dinner table talking about this, and motivations of sellers needing sort of the tension between perpetuating as a steward what God's given you and being willing to make sacrifices for that on one end, and on the other end having a certain amount of cash at close for liquidity and diversification and sort of all those reasons. And a guy made this comment that, and I hadn't really heard it before, and it made a lot of sense, is put yourself in the shoes of that guy. He can have the best heart of any man you've ever met and wants to do the right thing, but he doesn't know if he's going to live for the next 5 years or 7 years. Maybe he's not healthy. Maybe it's the most responsible thing for him and his family to indeed get enough cash at close so that he's taking care of his family, because he doesn't know whether he's going to. None of us know our days, right?
No.
And so that can become an important aspect of solving these problems, which is why this structured equity asset class, this type of investment is so important to be focused in these ESOP transactions, so that you can solve more of those problems and more kingdom companies can be perpetuated.
Yeah, well, and it goes back to why not start early in the delegation process, getting yourself out of the center of the wheel.
Yeah, I just was going to your earlier point. I was going to say what I've observed is that when the guy's at the point working with you and he's wrestling through these identity issues, these issues of how do I extract myself from the bit, not just my capital, but how do I extract myself from this business, in the most appropriate way. There's when you do that, when you call everybody together in a 2-day strategic planning process to get everybody speaking into and focused on a 24-month goal where everybody sort of buys into where the business is going, that's healthy. That's a good thing to do. But when you do that and you're also at the same time layering in employee ownership, beneficial ownership vis-a-vis the ESOP, and now everybody is integral in developing strategic objectives and quarterly goals towards a 24-month endpoint, and at the same time that they're understanding that their financial motivations and incentives are turbocharged by virtue of this ESOP that comes into place, that if they can achieve these goals and they can continue to watch costs in the business like a business owner would rather than an employee, because it puts serious money in their pocket at retirement, that's when you see turbocharged success and performance in a business. And that can get that's the right way to do it. That's the right thing to bolt on to all of the work that you guys are doing holistically and that strategic planning work. You're putting gas on the fire in a positive way.
And that's that CEOP, the collaboration effect on profit.
Yeah.
That effect is, and it's not a magic or silver bullet or magic pill. You have to still do the hard work, right? You have to guard against the vices, egotism, territorialism, fear, greed, anger. You have dishonesty, right? You got to guard against those things, because that's the formula for doing what you need to be doing to achieve the benchmarks. But when you get those things humming, right, you're spinning that flywheel. Collins talks about the flywheel. You get that flywheel moving, then it's easier to keep that going, right? And you have to continue to check each other. You have to continue to collaborate well. But profit is not just dollars in that statement, collaboration effect on profit. We talk about Mark 8:36. What does it profit a man? To gain the whole world, but forfeit his soul. And so you look at this and say, and this is one of the litmus tests we have. We say, hey, what's most important? Getting what you think you're owed for the blood, sweat, and tears that you've poured into this business. Is that where your heart is? Is that your motivation? Is that what you're trying to do? Or, just because you didn't plan well, just because you took the short road for many years, you're letting go of what could be a blessing, a perpetual blessing, like you're saying, to the rest of these groups. And that's just a little bit of hard love with some of these business owners who, they're saying, me and mine, that's the number one priority. And again, it is. Hey, you have to take care of your family. You call to your family first. You have to take care of your family. But it is a little bit of a hard conversation to say, I'm looking at the way you've lived and planned. You've used this company as a ATM, and now all of a sudden you need a big cash flow moment, windfall, to be able to then set your family up in the legacy that you prefer. And it's going to be at an expense. There's always an opportunity cost of going in one direction or another. The health question, you can't argue with that, right? But that's going through the proper check. And this profit idea is emotional, physical, spiritual, wisdom, family, and financial.
Yeah.
If you only focus on the financial transaction, right, even with the tax implications, what does this mean? So going through that idea, gain the whole world but forfeit a soul, that's what profit is. It's just an advantage. You've been given resources, you've created an advantage of them, but what you got out of that, did you have to forfeit your soul? And if you did, hey, that's going to be a hard conversation one day in that person's future. It ain't going to be with you or me. It's going to be with the Lord
at the Bema seat. That's right.
That's right.
How you define success is everything. And so your approach to helping them get clarity, how indeed they do define success, is a game changer.
Mm-hmm.
Game changer, and it's exactly the help that they need.
Yeah. One of the things that I like about this ESOP question and exercise is it helps you orient, right? You're taking what I believe is one of the most noble transaction opportunities. It depends, right? You may have spun off a company and you're just growing it. It doesn't take a lot of manpower. You're growing it and you're going to sell it to private equity one day because they want to roll it up into some turnkey thing or whatever the motivation is, right? That's a little bit different. That's an asset that doesn't necessarily impact a lot of stakeholders. You can kind of talk through the different assets and what they mean. But like you're saying, 30 plus with a couple of million of EBITDA, there's dependency on that. There's purpose in that. It takes a lot of people thinking and working and exercising and coming in and saying, I'm a part of this story and I'm going to help build it. So it's a very noble approach to consider the ESOP. And when you do, you're able to look at it and say, if this is not it, I've at least paid attention to it. And one of the other misconceptions that, I look at and hear a lot of the time is it's just too expensive. It's just too expensive. It costs a lot of money to do that. It's just too expensive. Now, it is if you don't meet that threshold, right? Because then, it is too expensive. It doesn't make a lot of sense. It's going to cost you a lot of money to put it in place, and you may not get that amount of benefit out of it. But if that's the only reason you're saying it's just too expensive, too complicated, and too many attorneys involved, and too many of this and everything else, that's not okay. How do you address that objection?
That's so lame. I hear that so often, and whenever I hear that question, or whenever I get the comment, it's too expensive, my answer is always, compared to what? And I've yet in 30 years to hear a good answer to that question. Too expensive compared to what? Too expensive compared to continuing to give the government 30 to 50% of the profits every year? I mean, the cost of doing this transaction is a sliver fraction of 1 year of tax bill that you're writing checks for. Moreover, if you're going to hire an investment banking firm to take you to the market and get multiple bids from private equity groups and strategic buyers, the cost of doing that transaction is double what it would be, all in, double what the cost of the ESOP. The ESOP transaction is about half of it. It feels like it's more because you're writing checks to more people and there's a lot of people involved, but total dollars out, it's half the cost. And so there's just so many misconceptions. And when you understand the cost relative to what your alternative decision is of running a sale process, it's for sure less. When you contextualize the cost of the transaction compared to stopping taxes forever against your earnings engine, it's nominal, right? So it's having the right context.
Yeah.
And most people, I'm going to go off on a tangent here. Most business owners turn to their CPAs. They hear all the great things about the ESOP. Hopefully they also hear what the disadvantages are, because there are a couple of disadvantages to talk about. But
let's go over those next.
Yeah. But on the whole, the advantages always outweigh the disadvantages. And it sounds too good to be true. They talk to their CPA, and that's the trusted advisor typically with respect to the business. And then the CPA 8 times out of 10 does what I did when I was younger in my career and I didn't understand the ESOP. You poo-poo it. When you get put in a situation where, as a professional, you're supposed to have you're supposed to have the answers and you don't, and the client asks you about it, you muddy the waters, you obfuscate, you say it's too expensive, it's too complicated. You say those things to move them away and over to the more traditional transaction form, which everybody understands, and it's just an easier way to get it done. And so I get that, because I did that. But the older CPAs in the country that were practicing when these laws came out in the late 70s understand it. And the 2 out of the 10 CPAs in the United States that understand it are big proponents of it. And which is why I wrote the book, so that younger generation CPAs can read that book in a weekend, understand it, and be in a position to advise clients in a more informed way. What's really interesting, last thing I'll say here, yesterday, a press release hit the wire where BDO, the 6th largest CPA firm in the world, just announced an ESOP for their 10,000 US employees. So it's the first time that there's been a handful of regional CPA firms that have done this, but it's the first time that a very, very large accounting firm, really smart guys, adopted an ESOP transaction. So we're starting to see, and this will be a moment in time that I think will change the perspective of ESOPs within the CPA community, for sure.
How about that? Yeah, you would think that CPAs like to save on taxes.
Well, not only that, but CPAs are losing their clients when private equity buy them, right? So it's in their own interest.
Yeah.
Understand how that business can be the independence can be perpetuated so that they can keep them as a client. And once you understand it, that it's better for the client, they're going to get just as much money, if not more. Mm-hmm. And everybody wins. But it's just a matter of education, mm-hmm. in contextualizing that ESOP path chunk of education compared to private equity, strategic. And so they can, again, how you define success is everything. Success here is they understand it because they didn't understand it before. Now they understand it and they can pray in a more informed way. And then there are guys where they hear a word from the Lord that they're supposed to sell that business to a strategic buyer and shift all that risk to somebody else. And who am I or anybody to say that that's not what you should do? If you hear from the Lord that you're supposed to do that, then that's what you're supposed to do. But too many people don't understand or get talked out of through misconceptions or bias that they shouldn't look at this compared. Any company that a private equity group is interested in buying and expressing interest in is a candidate for the ESOP transaction.
Yeah, the Lord likes context. And he likes us to trust him, but also to use information and other trusted people that he's working through, especially on a big decision like that. He doesn't just, it's not just a poof at, hey, you need to go do this. And, all the people who you trust and are in the saddle with you, they're like, where did that come from? Right. It's still you may lead in that direction and it may become more clear, but it's not just a magical, hey, this is what I heard, so this is what we're going to go do. And no, it doesn't make sense to anyone. And it really is the dumbest decision ever, but I still think it's what we need to do. That's a hard sell, right? That's a hard thing to up and decide to do. One example of that is, and I know some people have put their entire company in or the majority of it into a donor advised fund.
Yeah.
Right. Or they put it in a trust.
Yeah.
And I'm selling my business to the Lord. Well, no, you're putting it in a trust and there's a trustee, right? The formula has not evaporated. God cannot be listed as a trustee on your right. And then the beneficiary of that is still a group of people running a 501c3. There's still, it's always men involved. So you don't actually sell your business to God, right? You can give it all away to the purposes and the specific groups that you want to. But at least as far as I've seen, there's no way to put God as a trustee.
If you are a steward, if you're listening to this and you really know that you're a steward, or you think you're trying to figure out what does that mean? I know I'm supposed to be a steward, but what does that mean? If you're a steward, I would say that it is your responsibility to understand this alternative. It's not your responsibility to execute on it. That's between you and the Lord, but it's certainly your responsibility to understand it so that you can pray about it and then be led with what you should do and have peace about whatever path you're going to walk down.
So you do a feasibility study, right? We've talked about that in the past, and you do those a good bit. The feasibility study is simply that. You're checking to see, right? You're going through and checking the boxes and saying,
it's looking at
is this a legitimate opportunity and path forward or not? If it's not, you cross that off the list, right? It's just that due diligence and feasibility. So how does that process work?
Yeah, so it's the net on it is we look at the last 10 years of history of the business, we look at the present condition of the business, and we look at the projected 10 years of the business revenue and EBITDA, and value the business within 5%, within a 5% range of where that business will ultimately sell to the employee trust. So here's what businesses is worth for purposes of transacting. And oftentimes we're saying, here's what you could get from a private equity group. And those numbers are almost always exactly the same. And here's what you might get for the business if you sold to a strategic buyer. And sometimes those numbers can be higher, it just depends. And so here's what the business is worth down all three of those paths. And now you take that valuation range and you layer it on one or two ESOP scenarios. So one scenario could be selling 49% now and maybe selling the rest 7 years later and sort of test driving it. The other scenario is selling 100% to the ESOP now, and so what does that look like? What kind of liquidity happens at close? What do payments look like? What do tax shields look like? How do employees benefit from that? So it's sort of getting under the hood and then really unpacking it. So instead of theoretical, it's okay, now I'm taking those theoretical concepts and applying them to a very specific company fact pattern, and it's the blueprint for the build. So this is exactly what you could go do within 5% variance, and now you know what it's worth, what you could go accomplish with it, and you know that in context of what else you could go do, and then you pray about it and decide that you don't want to do it or you do want to do it. And if you do, then that's a separate. So that first phase is like a 30 day, pretty nominal, 10, $15,000 depending on complexity, and 4 or 5 hour, session that learning session that punctuates that. And then you're in a position, I think, to decide whether you want to go do it. And then that becomes a separate conversation. But you asked about disadvantages, and I want to come back and hit those really, really quick before we move on.
Yeah.
The employee trust structure is an amplifier. It is not a prophylactic around the business that protects it from dumb decisions or bad markets. Right. I mean, those realities can exist whether or not the corporate structure has an employee trust or not. So it's not perfect. It doesn't make all potential problems, extraneous problems go away. But excuse me, but you're able to look at it, understand it in the context, and be able to decide whether it's the right thing or not to do.
So if you put the company into a trust, then you can still make a dumb decision and it negatively impact the success of the company.
Yeah, it can. So it's not a prophylactic for that.
You can't ever, if a person, a team, that goes back to, you got to pay attention. You got to work hard. You got to collaborate at a high level. You got to pursue strategic best practices. You still got to, it doesn't put it on autopilot.
Yeah. So it's an amplifier. So if the company stumbles, either for management's fault or no fault at all, it amplifies that stumble, because conversely, when the company succeeds quite well, like we talked about before, it amplifies that success. When employees know that there's direct linkage between the financial incentives, personal financial incentives, and the stock price of the business, the profitability of the business, that amplifies success. It works both ways. So that amplifier can be, not always, but can be a disadvantage. And then the other thing I would say is that you've got, and the average ESOP transaction is going to cost $50,000 a year in additional compliance work, which is not a big number. It's certainly not a big number compared to the magnitude of taxes that are stopping as a result. But you have, so I wouldn't say that the cost is a disadvantage really at all, but you have another layer of compliance, right? So most businesses have 401k plans, and they have a third-party administration firm that they pay to keep that plan in compliance. You have one more plan to keep in compliance, and it's a little bit more, compliance work basically for the business. And those are the two disadvantages, I would say.
Yeah, and not to spin the disadvantages, but we talk about transparency, right? If you and when we're putting together the key leader win, we let the owners know, hey, we're seeing everything, right? We see the financials top to bottom. We look at the history. We kind of talk through some of those things. And you can see in the financials where some normalizing needs to occur, and the owners say, "Hey, I don't want these folks to know about that." Now, it's within the legal parameters, right? Some certain things that need to be normalized. But if you took it to the market, everybody's going to look, right? In your underwear drawer, they're going to look, right? They've got to. You can't do it. There's no good deal where it doesn't happen. That transparency,
Right.
and so if you're asking these folks to step in that direction, now you're not going to manufacture. You're not going to say somebody on the line gets to see, all of the financials top to bottom, all of the ins and outs, right? There's still layers of transparency that exist, but the idea is, yeah, if you don't make a good decision, right, then people are going to know about it. That's the same thing as a publicly traded company, right?
Right.
Yeah. There's transparency, and it may not be the same level of, well, this is my sandbox to come and play in and just have, you still have to, if you're committed to being a great leader and a great owner and overcoming the vices and promoting the virtues in yourself and all the other people who are integral to the success and leadership of the company, then it may seem like a disadvantage, but I disagree. I don't know if it's a disadvantage. The compliance thing, I don't think it's a disadvantage either. It's just extra work, right?
Yeah.
It's a cost of that, and it still may be an overhead cost to go through that whole compliance thing, right? And the people and the training and getting everybody up to speed, and that's why there's ESOP associations, right? They do all of that training and get you caught up to speed, and help people who are in finance and HR. They get together and train each other and kind of help them out understanding what their new role is in an ESOP company. But
it's not daunting. It's like anything else.
Yeah.
We're all of us as human beings are afraid of what we don't know. And so once you understand it, you devote 40 hours to understanding it, then it's really not that big of a deal. But it's transparency. The employees only they don't see financials. They don't have any additional rights or preferences or anything like that. But they do see a statement with how much stock they vested into and the stock price every year. So they get in the direction of the company.
One of our clients told us, just talking about their story, they've been in ESOP for, years and years. And the original owners are out of the situation, right? It has succeeded to the next generation. And they talked about one of their meetings. I don't think it was a receptionist, but close to that level employee, right? We're not talking about a highly paid individual. They got their statement. This lady got her statement at a big company meeting, right? But they talked about, here's the increase in the value. And her statement said that she was a millionaire. And she ran forward with it and was announcing her resignation. She said, "I'm out, right? I've hit it. I'm out." Her husband was chasing her saying, "No, wait a little longer." Because it's not only going to go up, but it's going to go up, right? Things are good. They have the chance to continue to improve. Why not be a little bit more of a millionaire if you wait a couple more years? But she said, "No, I'm out. I'm done. Grandkids and hobbies and whatever else she wanted to do." But that's an example of a great story that can be told.
Yeah, by the
for
way,
so many people involved.
Yeah, that's a great story. It's worth mentioning that structurally, when you structure these ESOP transactions, the way we do it is you always have a 5-year lag period between when the employee leaves the business. So they look at their statement and they've got $1 million or whatever it is. They have to wait 5 years, the way we structure these transactions, in order to get that $1 million. So what you don't want to do is create the whole premise behind employee trust is incentives work, right? When you incentives to people, they behave. And so what you don't want to do on the flip side of that is you don't want to create an incentive for people to bail and immediately get paid to bail, right? So you can 5-year lag period. So you can make that decision to bail, but you're not going to get that money for 5 years. So
now they can immediately begin to draw on their 401k side of the account, right? Assuming they're 59 and a half and they've done met all the other parameters.
Yeah.
But that specific piece, which is separate from a 401k, sometimes, there's some nuances that you got to get into that we don't have time for today. But those are the things that I think are you can customize the plan to meet your needs. It's not out of the box. There are features of it that you can customize. And that's when we tackle the key leader win question, right? And typically it's deferred compensation. It's a couple of different things, stock, different things like that, especially if they're not going in this direction. You can still do some of those things, but ESOP is a little bit of a different direction. But it's not a one size fits all. You customize it because no two companies are the same. No two groups of key leaders are the same. No two owners are the same. No two time periods are the same. So you have to be able to customize it. And that's what you're sounding. People can get, once they get a handle of how it works structurally, then they learn those levers they can pull to make it their plan.
Yeah, it's highly customizable.
Yep. All right. I think I learn something new every time we talk, and I know that the audience has a great foundation to go with. So if they need to get in touch with you, we'll put your name of the company in there. And then anybody that's listening, if you want to reach out directly to Brandt, holler at me at Legacy and I'll connect you with Brandt. But thank you, Brandt, not only for the technical expertise, but also the passion and the heart and the conviction around this. And it just took a couple of years of roto-rooting to get you in a position where you could walk in this path that the Lord had for you the whole time.
Yeah, that's right. Well, thank you very much for having me. I appreciate it. Hopefully there was a little bit of value.
Indeed it was. Thank you very much.